Look at your bank balance right now. Those dollars feel solid, earned, and safe. But here's a fact most people in the modern world never hear. If everyone tried to withdraw their money tomorrow, the banking system would collapse within hours, not because of a hack or a crisis, but because the money isn't fully there to begin with. This isn't a conspiracy or a theory. It's how the modern financial system is designed, and once you understand it, you'll never look at money the same way again. When you deposit money into a bank, you imagine it sitting there untouched waiting for you. But in reality, the bank keeps only a small fraction as physical reserves. In much of the Western world today, reserve requirements are extremely low, sometimes effectively zero, meaning most of your deposit is lent out almost immediately. That loan gets spent, deposited into another bank, lent again, and so on. Your single deposit doesn't just sit still. It multiplies across the system. What began as $10,000 can quickly turn into $80,000 or $100,000 moving through the economy, not as cash, but as bank-created credit. Only a small portion exists as real central bank money. The rest exists because everyone trusts that not everyone will ask for it at the same time. That trust is the foundation of modern money. This idea didn't begin with apps, ATMs, or digital banking. It began nearly 1,000 years ago. In 11th century China during the Song dynasty, traders grew tired of carrying heavy metal coins. So they deposited silver with trusted keepers and received paper notes in return. At first, every note was backed by real metal, but the keepers noticed something important. People almost never came back all at once. So they issued more notes than silver they actually held and loaned those extra notes for interest. Money was now being created from promises. As long as trust held, the system worked. When trust broke, it collapsed. Europe learned the same lesson centuries later. In 1661, Sweden's Stockholm's Banco issued Europe's first paper money. It worked until it didn't. Too many notes, too little backing, a bank run, and collapsed by 1668. France repeated the mistake in the 1790s with the assignats, backed by seized church land, printing more and more until prices doubled every few days and paper money became so worthless it was burned for heat. History was sending the same warning again and again. For a long time, money was at least loosely tied to something real, usually gold. But that ended in the 20th century. The United States severed the dollar's link to gold domestically in 1933, then ended it completely in 1971. From that moment on, money became pure fiat. It had value because governments declared it did, and people believed them. No metal, no anchor, just trust. Today, money isn't printed. It's typed into existence. When a bank approves a loan, it doesn't lend existing money. It creates a new deposit. Over 90% of the money in circulation now exists this way. The balance in your checking account isn't central bank money. It's bank credit. Central banks amplify this process through tools like quantitative easing, buying government debt, and injecting new reserves with keystrokes. The US, Europe, and other developed economies have relied heavily on this system, especially since 2008 and the 2020 crisis. The system runs on ever-expanding credit, and that creates three unavoidable consequences. First, inflation. When money grows faster than real goods and services, purchasing power erodes, not because people suddenly become greedy, but because more money chases the same reality. Second, endless debt. Money is created as loans, and loans require interest, meaning more debt always exists than money itself, forcing constant borrowing, refinancing, or new money creation just to keep the system running. Third, unequal power. Those closest to newly created money, governments, financial institutions, and asset holders, benefit first, while wages and savings adjust later, if at all. This isn't accidental. It's structural. History shows what happens when trust finally breaks. Weimar Germany with wheelbarrows of cash for bread, global financial markets freezing in 2008, and massive central bank interventions to prevent collapse. Each time, the response is the same: print, lend, stabilize, repeat. Without constant support, the system seizes up. Fiat money isn't fake, but it is fragile. It depends on trust, debt, and continual expansion. And if everyone paid off their loans tomorrow, the money supply would shrink rapidly and economic growth would stall. That's the paradox at the heart of modern finance. So what do? Not panic, but understand. Real wealth has always been the same. Skills, productive assets, strong networks, and things that retain value beyond financial promises. Fiat money is a tool, not a guarantee. Inflation isn't an accident, and debt isn't a glitch. It's how the system functions. Those who understand it adapt early. Those who don't keep wondering why life feels more expensive every year. Empires, governments, and societies have learned this lesson repeatedly. And modern money still runs on trust rather than substance. A trust that can disappear faster than people expect. The next time you open your banking app, remember you're looking at promises, not certainty. Understand the system. Don't confuse numbers on a screen with real security. And if this helped you see money more clearly, subscribe. Because history explains the present, and I'll keep showing you how.